Consumer price index misses expectations, which is finally a good thing. Good news for the markets, good news for interest rates, good news for our economy. Let's dive into that. So we've got mortgage markets, S&P 500, and we'll focus first on the 10-year Treasury, which is down a little bit less down today, right now. It's Wednesday, 2.76%. It's actually started the day off much lower. It's come back up a little bit, but for the most part, we're down. We're below the 100-day average, the 25-day average, the 50-day average. Overall, we think the interest rates have peaked back in June, and they seem to have been trending down. Other anomalies that we've noticed and we've pointed out in the past here is the 2-year Treasury, even the 1-year Treasury is actually, you get a higher rate of return for 1-year investment in a U.S. Treasury note than you would for a 2-year, much more than a 10-year. And even the 1-year and 2-year are inverted over the 30-year lifespan on the 10-year Treasury. What does that mean? It really basically just means that the stock market, the bond market specifically, has priced in that this inflation that we've seen, these huge inflation numbers. Today, the core inflation came out at 5.9%, which was a little bit less than expectations. They had expected total inflation at over 8.7%. It came back at 8.5%, so slightly under expectations. So a good thing, maybe a turnover on inflation. So what does that mean with rates? So Freddie Mac puts out a survey every week, and they finally put a 4 handle on the average interest rate as of last Thursday. So I commented that back in June, we probably peaked in interest rates. That, according to the 10-year Treasury, we see on June 16th, that peaked at 5.78, 5.8% that last week in June. We had a dip and then a rise, and then this significant fall this last week has been really one of these things where the Federal Reserve has come out and raised their interest rate. So people expected to see interest rates go up. But the markets have priced in these interest rate hikes, and they're starting to price in the future of interest rates falling, specifically around the economy turning down, more negative than it already is. According to GDP, U.S. Gross domestic product was down the last 2 quarters. So for the first half of 2022, there's been a reduction in gross domestic product. The second quarter, a lot of that was from the inflation. The inflation took away the dollars that people had to spend. So it took away from the total production that the economy can put out. Supply chain demand issues. It's going to keep stacking up. So summer's coming to a close, but we'll just keep an eye on it and keep an eye on the next report. The next Federal Reserve meeting is not until September, so there'll be a few more months or a few more data points to come out before they have their next announcement. It is projected they'll raise the short-term interest rate again. At some point, we'll see them slow that down. So if they raise it less than 75 basis points, that would be seen as a signal that things are slowing down and that they're approaching what would be their top end of the federal funds rate. With that, have a great week.